Saludamos a Charudatta Shende, Head of Client Portfolio Management Fixed Income at Candriam. Hi Charudatta, good morning.
Good morning, I hope you can hear me. It's a pleasure to be here.
How does the recent rate cut reflect on the central bank's operational independence from political pressure? And what mechanism ensure its decision remain insulated from short-term government objectives?
Yeah, thank you for the question, and it's very topical. I think it's first to address the recent rate cut. This wasn't a surprise. Markets had widely anticipated this rate cut, given what we've seen, meaning a softer labor market and not major upside shock in inflation. So if inflation is relatively controlled and the labor market is softer, markets did expect this rate cut. It was in line with these expectations. And to be honest, the vote was fairly consensual. There was a dissent, but I mean, which was calling for a bigger cut, but there was no real major issue there. Now, the question is, what about the independence from political pressure? Right now, we're not seeing it. Because as I said, rate cut was expected and that is what we got. However, if you look at the dot plots of the Fed, then you see, and the dot plot reflects where policymakers think rates are heading, you see the median projection is 2 more rate cuts by year end. But what you see in the dots is that you see a range. One member saw at least 5 rate cuts this year. Another member actually indicated a hike. So there is a large discrepancy in the committee, and to a certain extent, this divergence, 5 rate cuts, is in line with what the Trump administration would like to have. But at the same time, let's not forget, yes, we have this element that indicates that the Trump administration's policies might have a greater influence, but at the same time, other Trump appointees continue to vote in line with overall consensus. So to answer the question, at the moment, we understand that the political pressure is being talked about. We don't see it much in any of the Fed's activity. Now, the mechanism, the second part of your question was the mechanisms to ensure that the Fed remains independent. Of course, look, the structure is open to political influence, like many central banks can be. Their independence is very important, but let's not forget the Fed chair is nominated by the president, and governors, they're confirmed by the Senate, and Chairman Powell, his term is up next year. So though he will remain on the board, he's no longer going to be Fed chair. He's going to be replaced, presumably by a Trump candidate. But so there is that influence. President Trump could have someone who is very close to him in the Fed chair, and as a result, you can have some political influence, but there are other members, and many of these members, including Powell, who can stay on the board for a little longer, they all still continue to vote relatively independently, and as we saw recently, getting rid of a member is difficult. They're trying something with Lisa Cook there, but it seems like the process is very long drawn. So there are some very strong guardrails there that try to make sure that monetary policy is not dictated by short-term considerations. So to fully answer your question, the recent decisions are still based on economic fundamentals. They're still based on, what is going on in the market rather than politics. Even though the Fed is not completely insulated, there could be political pressure. That pressure takes time to be influenced. And right now, we don't think it's happening.
Considering the current rate environment, how does central bank independence affect the pricing of corporate and sovereign credit risks in domestic and international markets?
Again, a good question, because when we talk about central bank independence in this kind of a rate environment, which is a higher rate environment today, it really matters for how investors think about credit risk, sovereign and corporate. If rates are relatively high right now, the bias is towards cutting. And if the bias is towards moving lower, then clearly, markets are somewhat positioned for that. If the investors believe that the Fed is acting on the basis of economic fundamentals and acting independently, then that keeps the longer term expectations fairly anchored, and it reduces the extra risk premium that investors demand for holding riskier debt. I mean, in the US, let's look at it, because we're asking how it affects the pricing of sovereign and corporate debt. You can see curves are already they've already steepened, and we believe that there is room to steepen a little bit more because the short end is under pressure because markets anticipated rate cuts. Long end, you still have questions around higher debt, fiscal expansion, and perhaps, of course, the inflation risk from tariffs. So the steepening dynamic is taking place. In Europe, perhaps the steepening dynamic is a little less prominent, but it's still there. The long end is still challenged by technical factors. You have Dutch pension reforms that are making demand for the long end lower, and so the long end is still likely to move upwards slightly, whereas the short end is anchored by ECB, which is not ready to raise rates in any way, rather is in a pause in their cutting cycle. So all in all, on sovereign rates, we can expect this steepening to take place. You need an independent central bank to make sure that markets are reassured as far as this goes. And look, for credit markets, both in US and in Europe, look, let's not forget, steepening generally means that the short end is lower, and as a result, investors are going to see that issuers want to come and issue more on the short end. Look, we've been in a high rate environment for a long time. Now that rates are coming down, companies want to hurry up and refinance themselves. They've been waiting for this for some time. On the other hand, the long end moves upward, and that creates a wonderful yield for investors to buy. And so we do expect in the near term there to be more movement on short-end credit, but in the medium term, some wonderful opportunities are being created on the long end, and that for us is something that is important. We do not neglect the fact that for all this opportunity in credit to materialize, central bank independence is fairly key. I mean, they are looked at as the risk managers of this environment, and for them to be present is going to be very important.
Finally, to what extent can the central bank's independence mitigate systematic risks in the credit markets during periods of monetary easing, and what are the limits of its influence?
I think central bank independence is absolutely crucial, as I said earlier, when we're talking about systematic risk, systemic risk, in fact, in credit markets. Independence gives policymakers the ability to act quickly and decisively without being subject to political pressure. And that credibility is quite important for investor confidence. If you look back at the last 30 years, there are plenty of examples where the Federal Reserve and the ECB were, during the great financial crisis of 2008, during the COVID crisis and that followed, and even the Eurozone sovereign debt. If you look at as recently as 2023, when we saw the collapse of SVB, we saw the failure of Credit Suisse, in these moments, central banks were able to step in. Not because it was politically important, but because they had the independence to act as the risk managers of the entire financial system. And so, they really can mitigate these systemic risks, provide liquidity, reassure markets that systemic contagion can be controlled. And that is why their independence is also important. Now, monetary easing, because we're talking about in credit markets, monetary easing in particular can help credit markets very, very clearly. Lowering long-term rates reduces funding costs, makes refinancing easier, and tightens credit spreads, and investors feel more confident. So that's why market has responded quite positively to generally what the central bank does in terms of easing, provided they're doing things for the right reasons. Now, you mentioned something very important, which was the limits of what the central bank can do, and that we have to be quite clear about. They can mitigate systemic risk. There is no problem with that. We talk about it. But what they cannot do is solve idiosyncratic risk, which is part of the credit market. Central banks cannot, they cannot repair a weak balance sheet. They cannot generate sales for a struggling business, and they certainly cannot fix weak governance or outdated business models. So defaults will still happen no matter how much central banks intervene. And in fact, in an economic environment, as we see, of slower growth, heavier sovereign debt burdens, higher tariffs, geopolitical risks, these weaknesses become more visible. So easing can buy you time, central bank intervention buys you time, but it cannot remove fundamental vulnerability. And because the central bank's independence is that important, it's ensuring that systemic liquidity crisis is dealt with, but it forces investors to differentiate more carefully between the weak and the strong credit. So in other words, central bank provides the guardrails, but investors still have to navigate the road. And in today's environment, with spreads being relatively tight, growth headwinds that are building, as I said earlier, bond picking, issuer picking, issue selection, instrument selection, and active management are going to matter more than ever. So again, to sum it up, yes, independent central bank will mitigate systematic shocks. They will keep credit markets functioning in difficult periods, but they cannot eliminate that idiosyncratic and that fundamental risk. So that is very clear, and that is very important.
Shende, Head of Client Portfolio Management Fixed Income at Candriam. Real pleasure for me. Thank you for coming at Negocios TV.
It was a pleasure. Thank you very much. I look forward to being there again.